spring has sprung and people feel more positive when the sun's shining. They also feel more positive if they're in business or a borrower when interest rates are cut. And that's been the major change for Aotearoa's economy in the last couple of months. A significant reduction in interest rates with the 50 basis point cut from the Reserve Bank and expectations for another 50 or maybe even a 75 at the end of November as the Reserve Bank has its last decision before Christmas. This week on When the Facts Change, we talk with Kiwibank's Chief Economist, Jarrod Kerr, about what he's seeing on the ground from businesses in reaction to that first rate cut with expectations of more. Just how much springing is going to go into the spring economy with these lower interest rates? And will the US presidential election upend the applecart? We'll find out more this week about interest rates, about business confidence, about the US election, and about what's coming up before Christmas in our economy. Well, kia ora, and welcome to When the Facts Change to our old friend of the show. Not that he's old, he's certainly a friend of the show, Jarrod Kerr from Kiwibank. It's great to see you, Jarrod.
Kia ora. Thanks for having me back on, Bernard.
It's been a heck of a time in the economy with the Reserve Bank cutting by 50 basis points. What did you think of that move? Because you were one of the first economists who came out with that 50 basis point call.
Yeah, I mean, we have been banging the table for a while that interest rate relief is needed. We've been through 2 years of recession, and we've just noticed that this year in particular, things are starting to snowball. The labour market's loosening, and businesses are seemingly doing it a lot harder, in the last 6 months than they have been at the beginning of the recession. So that is to be expected, but we're at a point now quite clearly where we need interest rate relief. We need policymakers to start thinking about making things a little bit more neutral, so not so restrictive. And we need businesses thinking to next year and the year after in terms of growth and expansion rather than just putting out fires like they're currently doing.
There's one more chance before Christmas for the Reserve Bank to give us a treat. How big do you think the treat might be?
Oh, go 50. You heard it here again, and hopefully they deliver again. From my point of view, 5.5 was a very, very restrictive rate. They cut 25 and then a 50, and I'd like to see that closer to 4% by the end of the year, and I'd love to see it below 4% early next year. Because what I think about when I'm thinking about monetary policy is how restrictive is it? 5.5 is clearly restrictive. 4.25 is less restrictive, but still in that restrictive territory. And then we debate, well, where's neutral? The current guesstimate is around 275. Whether they get to 3 or 2.5 or somewhere around there, there's still quite a shift lower in interest rates to be done.
There's been even some talk of a 75 basis point cut. What do you reckon? Go for the doctor.
Certainly in the realms of possibility, but I don't think it's something the Reserve Bank needs to do. Like I said, they can do 50 in November. They can do another 50 in February, and by that point, I think they would have done quite a bit in terms of removing the restrictiveness, and then they'll drop down to 25s as they fine tune it from that point on. So 75, sure, why not? It certainly gets us lower faster, and given there's a long wait between their November decision and their February decision, you can sort of come up with that argument. But I personally think the Reserve Bank will just deliver another 50.
So, what are people out in the business world saying and doing after that 50 basis point cut, and with fairly broad expectations, of another 50 before Christmas?
In my role, I'm privileged. I get to run around I'm currently in Wellington. I was in Tauranga not so long ago, Hawke's Bay. I do quite a bit of travel for this role, and I get to speak to all different types of businesses across the country. What I've noticed since the first rate cut in August has been an immediate response from businesses. Immediate. So, had I given a presentation in June, July, I would have been saying interest rates are going to fall. Next year is going to be a better year. Businesses would turn around and say, it's thanks for the optimistic view, but here are all the problems I'm facing. Now that the Reserve Bank's actually started cutting rate, it's no longer theoretical. You can see it. It's tangible. It's happening. Businesses are turning around to me and saying, how far are they going? What does this mean for asset markets, spending in the economy? They've lifted their heads almost immediately, and they are looking to next year with much greater optimism, as we are.
And how long will we have to wait before that starts to show up in the numbers, in the tills, in the job ad series?
I think some of it we'll see immediately. Like, we're looking to Christmas thinking, well, if they've delivered, 125 basis points by November, that might just loosen the purse strings into Christmas, which would be nice for retailers. More generally, it takes, up to 18 months to fully feed through the economy. I think it's going to be faster this time, that transmission from cutting the cash rate to hitting the economy, because most Kiwis are fixed for less than a year now. In fact, most of our customers have chosen the 6-month rate, which is actually really short, a short rate for Kiwis. So they're going to roll off in the next, few months, and they'll be feeling the relief of lower interest rates much faster than they would have, say, in the last cutting cycle. So I think we'll see a little bit heading into Christmas, and then a lot of it in the first half of next year. And if we're to have this conversation this time next year, we will look back and say, well, we did get 2-3% growth. Unemployment rates peaked and is heading south. Inflation's still at 2%. Monetary policy's been taken all the way back to neutral. 2026 is looking like a much better year.
Now, since we last spoke, we've also gotten some inflation figures, and we're seeing what's happening with wages. Can you give us a sense of where inflation is relative to where the Reserve Bank wants it?
So we're talking about the inflation return to target as being one of two phases. The first phase is the fall in international prices. So globally, inflation has dropped right back to target from most central banks around the world. Most central banks are cutting interest rates. This is good news. We are not importing inflation. So the goods and services that we're buying have actually dropped 1.6% in price. So that's huge relief coming from the tradables. The non-tradables domestically generated inflation, however, is heading in the right direction, but is still way too high at 4.9%. So the second phase of this return to target is going to be the domestic inflation heading back towards 3%. And we do think it takes place over the next couple of quarters. We've seen a number of indicators rolling over. You mentioned the labour market. The labour market has clearly softened and wages are heading south. So a lot of inflation pressure that we had built up in this economy has been released and is slowly returning to target.
Can the Reserve Bank, though, claim credit for that, or even the government? Because most of the fall in inflation has actually come from overseas, which the Reserve Bank can't really influence.
Can they claim credit? Well, of course, and they might do. But should they claim credit? Well, probably not. But you say the reverse too, right? Like the big shock in inflation to the upside started offshore. With the tradables inflation going like this and then spreading onshore. The reverse is happening with tradables inflation coming down, and that also helping to spread disinflationary pressure onshore. You're absolutely right. The Reserve Bank has very blunt tools that that impact the economy, and there is only so much of that basket they can really influence. I think they have done enough to suck a lot of the pressure out of the economy. When you're looking at business surveys, businesses they're not showing a lot of pricing power or intention. So to me, I think they can say job done, even though we're not quite there on the domestic front. They're definitely a lot more confident today than they were just a couple of months back. So job done, I think, is fair to say, although we need a few things to follow. And there are the frustrations around council rates and insurance premiums and stuff that make that a little bit more complicated further.
And how blunt is that instrument? Because we know when we slice into the onions that if you've got a nice sharp blade right along the knife, that helps. But how much of the knife actually does the slicing, if you like? Because it seemed very blunt for a long time.
Yeah, is it a knife or is it more like a sledgehammer? Probably more like a sledgehammer in the current example. You know, lifting interest rates, lowering interest rates has, magnified effects on some parts of the economy, very little impact at all on others, and you can have the opposite effect on different groups of people, right? So we're going through a rate cutting cycle now. Our savers are going to wear that, right? People with the savings, particularly those who are living on their savings in their later years, they're going to find themselves with less income as interest rates come down. But then more Kiwis have debt. So, for Kiwis with debt, they're going to get that relief. So net, it's a positive, but it's very blunt. It is a very blunt tool. The I guess the more precise tools can come out of government rather than the central bank.
Now, looking into next year, as people become more spendy, I suppose, where is the growth in the economy going to come from? And is it going to be a V-shaped a growth or more of a slow bounce?
I don't think it's going to be a V-shape. No, I think it'll take a few quarters to regain footing. I think the second half of this year is still pretty close to a recession, second half of 24, but the first half of 25 will be sort of gaining some traction, and I see growth starting to pick up in the second half, 2025 and into 2026. So it's not going to be this pure V, but it will look a bit more like a U, I guess, shape recovery. Generally speaking, we're saying, the rising tide is going to lift all boats, but there are some that have clearly been doing it a lot tougher than others. Anything in that sort of retailing, hospitality space, hopefully will start to bounce back over Christmas and next year as consumer spending, maybe returns to something more normal. It's not just about spending on essentials, but also spending on discretionary items. I'll see some bounce back there. Hopefully our tourism flows pick up. I think agriculture is going to do well this next year. Our manufacturers are doing well from what I hear. So I think it is a broad-based recovery that's going to happen, but there are some areas that have been hurt, and damaged in parts that we'd like to see bounce back as the consumer becomes a larger driver of growth.
Yeah, now just looking at the whole area of fixed mortgage rates, because one of the biggest influences on the economy is the cost of those fixed mortgage rates, which aren't directly connected to the official cash rate. Could you give us a sense of, what are the influences there outside of what the Reserve Bank is doing, and whether that might frustrate or give a tailwind to the Reserve Bank's moves?
Well, I think the one thing I would highlight is the move in wholesale markets. So wholesale markets generally move well ahead of the central bank, and we've seen that. Wholesale rates collapsed before the Reserve Bank started cutting, and wholesale rates have priced in some very aggressive rate cuts from now on. And we, as banks, have passed on some of that extra move in wholesale markets. So if you look at what mortgage rates have done, and you look at what the cash rate has done, not many of your listeners would realise that actually the banks have passed on more than what the Reserve Bank has done, because our wholesale rates have dropped so far. That's going to remain a big driver. I think wholesale rates are pretty fairly priced, and that is with a 50 priced in November and a 50 priced in February, and then 25s beyond that. It's about the Reserve Bank delivering those moves, which would keep that momentum, would keep that downward pressure on mortgage rates at a time when Kiwi households and businesses clearly need it.
But one of the other influences is the Federal Reserve, and their economic expansion has just carried on and on and on. They're having the softest of soft landings, despite all sorts of geopolitical dramas. Could a Federal Reserve slowing down its rate cuts, or maybe not having many at all, actually frustrate things and hold back some of the easing that the Reserve Bank might want?
Potentially. We've got to think about the frequency too. So, our next Reserve Bank meeting is November, and then the one after that is February. So there's this massive gap. The RBNZ likes to take a long Christmas holiday, whereas the Fed, they meet in December and January, and they'll have a few meetings in between. So even if they slow down to 25 basis points, we could still be tracking each other quite closely, even though the Reserve Bank of New Zealand's delivering in 50s, the Reserve Bank of the United States is delivering 25s more frequently. That interest rate differential will be quite interesting. As you rightly point out, the US economy is performed remarkably well, all things considered. And that stronger performance is why we think that the New Zealand dollar needs to go down, not up. And we got that horribly wrong. Even though pretty much all the data came in line with our expectations, given all that, we sort of said the New Zealand dollar should be at 57 cents, given all of that. But what happened on the US leg was quite interesting, and we actually had the currency go up to 63 cents. So it blew us out of the water. And then a few weeks later, the currency started playing ball again, and we've seen the currency drop back. We're now thinking that the currency drops to 59 cents, possibly a little lower next year. That actually helps the export market, the export sector of our economy. It gives just that little bit of an extra boost to our exporters. Does add a little bit of inflation pressure too, but I think the net benefit via our exporters is more important. So go Fed, do what you want to do, slow down if you have to, and if the RBNZ keeps cutting harder than you, then we'll get a weaker currency and our exporters will be thanking you for it.
Are there any events happening in the world in the next, few months that could upend apple carts all over the place?
Well, I'm surprised you said that with such a straight face, Bernard, with the US election coming along, and there are so many events out there that kind of scare us as well as market participants, as economists. I've been asked numerous times, what would a Trump victory do? What would a Harris victory do? I don't know. I seriously don't know, and I've been thinking about it quite hard. It was kind of different back in 2016, where we played what he was rather than who he is. He's a Republican, so he's pro-growth, he's pro-business, he's pro-tax cuts. The market took 3 or 4 days to figure out that, actually, this could be quite stimulatory, and bang, and equity markets took off. I don't think we'll get that this time because we know more about Trump today than we did back then. I don't know what happens in financial markets. But as a macro economist, I would sit back and say, yes, we're going to get some volatility over this period, but the US economy, the US Fed, they're going to be the main drivers of interest rates, equity markets over the more medium term. I guess that's my stance. Short term, no idea. Medium term, it'll be what the Fed's doing that counts.
One of the surprising things when listening to the debates in the United States is the lack of commentary around the need to tighten budgets and run budget surpluses. It's quite a different tone to the debates that we have here. And most of the economists and market players expect significant budget deficits in the United States, quite loose monetary policy, regardless of who wins. Is loose US monetary policy forcing the Fed to keep interest rates higher than they otherwise would, and therefore keep our mortgage rates higher than they otherwise would? The question I'm asking is, are a bunch of big spending Americans keeping our mortgage rates up?
It's a good question. I think it's one for the medium to long term outlook, and one that'll play out at the longer end of their curve relative to the short end of the curve. So those 1 to 5 year rates, pretty much driven by what the Fed thinks they need to do for the economy, and then the bond vigilantes that normally take advantage or try and mess the market around take place in that longer end of the curve. We certainly haven't seen that, but that would see, I think, a steepening in the curve if you're putting in risk premium into US Treasuries. It would take place out that back end, and that would influence the back end of our curve. Not so much the sharp end, that 1 to 5 year space influence our mortgage rates higher. It is a good discussion. It's the discussion that comes in and out of flavour every now and then, with the US debt just continuing to rise as a percentage of GDP. And it is a nice time to point out that US GDP, debt to GDP, I think is at 110%, and here we are in the low to mid 40s. We're so much stronger on that metric than the United States.
Jarrod Kerr there from Kiwibank, the chief economist, back to shoot the breeze on interest rates, economics in the global economy. Thanks again, Jarrod, and we look forward to talking again, perhaps before the end of the year, with some happy Christmas news to deliver.
Sounds great. Thanks for having me on, Bernard. Take care.
Mm-hmm.